Good afternoon, and welcome to the webinar for J. Stern & Co.'s webinar for our September update. I am Jerome Stern, managing partner of J. Stern & Co., and I'm very happy to welcome all of you and thank you to have taken the time to attend our second webinar. I am screen sharing, and you should see now the presentation. It is, and we will walk you through the slides. This webinar will take about an hour, and we will have a presentation for about 30 minutes, and we will have then Q&A for another 30 minutes. I draw your attention to the compliance, to our disclaimer and our compliance notices for everyone, which you see now on the presentation. We have two speakers today. So I'm Jerome Stern, as I said, a managing partner of J. Stern & Co., and we have my co-founding managing partner, Chris Rosbach, who is also a CIO and the portfolio manager of our WorldStars global equity strategy. I just want to draw your attention as well to that you can submit your questions to us in live form, either through the email address qa@jsternco.com or through the Q&A chat function, which you see at the bottom of your screen. Just in terms of agenda, we will do a brief performance review of the WorldStars strategy to date, and we will then discuss the portfolio positioning and then discuss our outlook. Just by background, we are an investment partnership managing the assets of my family, but also managing the assets of institutions, families, trustees, and charities. We are long-term in nature, and we are fundamental investors, always seeking to produce long-term returns. Let's start the performance review. We have generated 7.1% year to date in dollars, and versus the MSCI World, which has done 0.3%. That is on a short-term basis, obviously. If you look then at on a more longer-term basis, then you see on a 5-year basis that our fund, our strategy, has generated 96.6% over the last 5 years versus the MSCI World of 64.9%. So an outperformance of close to 32%. Equally on a 3-year basis, we have generated 40.3%, whilst the MSCI World has generated 25.6%. So almost a 15% outperformance. So this shows that our strategy has worked both on the short-term basis as well as on the long-term basis. If we go on to the next page and we focus a bit on what has happened this year. This year was obviously a very peculiar year, and we're very proud to set out that our unrelenting focus on quality has paid off. So you see this graph shows the performance of the WorldStars fund versus the MSCI World. And we have split the period in 2 parts. So on the left, you have the first quarter up to the 31st of March, and then you have the rest up to the 25th of September, which was last Friday. And you see here that when the pandemic was probably at its height, then the MSCI World was down 20.9%. Whilst our fund was down only 14.5%. So this created an outperformance of 6.4%. And what you see today, Today we are up 7.1% year to date, as I stated, but just before, whilst the MSCI is up only 0.3%, broadly flat. Thereby, we have an outperformance of 6.8%. And this demonstrates that our strategy has outperformed both on the way down as well as on the way up. I think this is a key component, which shows that quality always prevails. I think at this stage, I'll hand over to Chris, who's going to walk you through the strategy in itself.
Thank you, Jerome. Thank you all for joining. As you can see, the performance of the portfolio has been extremely resilient this year. And I just want to give a quick overview over the basic strategy and some of the key criteria that we look for when we invest, in particular for those of you who are joining us for the first time, but also as a refresher, as it were, for those of you who are very familiar with what we do. So the WorldStar's Global Equity Strategy is a concentrated portfolio of 20 to 30 great global businesses that we choose from a peer group of about 1,600 stocks. It's driven by our conviction that quality and value will generate returns over time. And it's based on our in-house research with our very experienced investment team. It's completely unconstrained, and it's only concerned with finding great companies that fulfill our criteria and that we think have the ability to generate value over time. I will take us through some of the criteria of what we mean by value and, by quality, and by value, we mean the ability to generate 8 to 10% or more, and in some cases, much more over the long term. We have separate accounts, and we have the UCITS that we are talking about that we launched in April of last year, and that has performed as strongly as you've just seen from Jerome's remarks. If we focus on quality and what we mean by that, when we say we invest in quality and value, it's 4 clear criteria. It's a type of checklist that we have, and it's companies that have a strong and sustainable competitive position in a good and growing industry, with a strong management, with a proven track record of value creation, you might say, as opposed to what, and a balance sheet so strong that they can weather any kind of adversity. And the first 2 criteria really tell you what we're looking for in a company that we'll invest in. By strong and sustainable, we mean that it has high barriers to entry and therefore is able to generate strong returns from the capital that it invests. But we also mean sustainable in every sense of the word, the ability to perform over the long term, but also, and I'll take us through it as one of the points I want to make as part of this update, in the sense of ESG, which is an important issue, but has been intrinsically linked for us with quality from the very beginning of the way we think about our investment approach. And a good and growing industry is one that has high barriers to entry, where there are leading players that are able to generate returns, and where there's some kind of reason for underlying growth. So whether that's economic growth, population growth, or some other kind of driver that's related to demographics or to technology or to some kind of disruption, these are the types of businesses that we're looking for because we think they have the ability to generate value. And very importantly for us, it's a forward-looking definition. So of course we look at the companies that have generated value in the past. We look at the ones that have had consistency in terms of their growth, their margins, their cash flows, and their ability to generate returns. But the real question is not what's happened in the past, it's what's going to happen in the future. And that's, I think, the key to the approach that we have and to our ability to generate value going forward over the long term. If we then think about what we mean by that, then we think that quality is worth paying for because it takes us straight into the discussion, and it's one of the points I want to make about where we are in terms of markets and where we are in terms of the opportunities that we see. We think that quality is worth paying for, as we say here. And we've put together some data for you that makes that point. Here we're going back, you've got 6 of the key positions that we have in our portfolio. They are very diversified companies. Some of them are related to digital transformation, which make up about 35–40% of the portfolio. Some of them are in consumer discretionary or consumer staples, like Nestle or LVMH or L'Oreal. And some of them are in life sciences and healthcare, like Thermo Fisher. So a very broad and diverse set of companies. And we've laid out for here what they were trading at in terms of price to earnings ratios in January of 2015 and now in September of 2020. And we've also laid out to you what those returns have been in terms of cumulative returns and annualized returns, and in particular, as you can see in the bottom of that table, compared to the MSCI World. So as you can see, these stocks were in January 15 not cheap at all. Adobe was trading at 61.8 times price to earnings ratio, Amazon negative, so not really meaningful, LVMH on 19 times, Nestle 21, L'Oreal 26, Thermo Fisher 18, compared to the MSCI World at 18 times. So you would say, well, they're roughly, in most cases, actually trading in line to the market or at a slight premium. And if you buy them, then they may have the ability to generate higher returns, but you'd say, well, they weren't particularly cheap, even if you just look at them at that period of time. You would have told us that Adobe is expensive. You would have told us that Amazon was basically uninvestable, even at that point, and you would have said the others are trading at a significant premium. And then I want us to look at where they are trading today, where in some cases they are more expensive by a factor of 20 to 30%. In other cases like Adobe, the earnings have come through in such a way that it's actually cheaper, although it is still trading at what is a higher price to earnings ratio compared to the market. But that is the valuation that we're looking at today. And that is what we have to confront when we're thinking about what opportunities these stocks are going to offer for us going forward. And you can see there has been multiple expansion. You even see it in the MSCI World, where there's been also a multiple expansion of, call it roughly 20% that's taken place. But now let's focus on the returns. So you can see in the period from 2015 to 2020, the cumulative return for these stocks has been very significant. The lowest one is Nestle, which is up 100% from if we had bought it at that point. But you can see there's a much greater range. L'Oreal at 115, Thermo Fisher more than double, LVMH more than double, Adobe sixfold, and Amazon ninefold. So very significant cumulative returns that obviously translate into very significant annualized returns as well. And we've also given you, in the very last column, the annualized returns from 1992 to 2020 to pick a very long-term period that starts after a crisis, but that clearly goes through an entire period of market history and economic history that comprises, for many of us, certainly for me, my entire professional career. And the point we're trying to make is you can see that quality is worth paying for. The next page, and to continue to argue on this point, and to also ask the question, not just what do we mean by quality and growth and value, but also how does it compare to what traditional people would look at in terms of growth and value. And we've had questions from some of you around what could happen and around what we think about the growth versus value debate and what happens if value comes back. This is how we think about it. So you have on one axis the price to earnings multiple, and on the other axis the earnings per share growth, so the classic metrics that you use to look at these things. And we've put some boxes there around the ratios. We can argue about exactly where they are, but what we mean by growth type companies and what we mean by value companies. For us, essentially then value companies are ones that trade at a price to earnings ratio below 15 times. That's based roughly on what Benjamin Graham said. It's based on what some value investing friends of ours think, and I think you would probably agree. For us, quality is the range that you see there, the box that encompasses the potential for both, that has significant earnings growth, but that also has price to earnings ratios that are not too elevated. So if you look at it, you can see that the MSCI World, and that's, I think, the key point from a portfolio perspective that we want to make, has a price to earnings ratio of about 22 times, as we saw, and basically is looking at earnings per share growth for 2021. So looking not at the end of this year, but the end of next, that is roughly in the 17% range. Whereas you look at the stocks that are in our portfolio, then you can see that they have a price to earnings ratio that is somewhat higher. But I hark back to the slide that we just showed you, and that, however, also has very significantly higher earnings growth. And that comes, in fact, from the fact that the digital companies that we invest in are looking at, and that goes to the opportunities that we see, have very significant opportunities going forward, almost no matter what happens in terms of the pandemic and the impact that it has, whereas a number of other companies, in particular in the consumer, in the healthcare and life science, and in the industrial space, have significant catch-up that we think will take place and that have the prospects for generating very significantly higher growth. So this is where we see where the portfolio is positioned and why we think that the upshift in terms of the valuations, and in particular in terms of the price to earnings ratios that you would look at, are worth it in terms of the growth that they have over the short term, as you see in this slide, and over the medium to long term, as you saw in the previous slide. So that's the point I want to make here, and we're very happy in our Q&A to go into greater detail on that. What it translates into is that we have a focus on specific drivers and sectors. So as you know, we look for, in terms of the quality criteria that we apply, businesses that have the ability to grow over the long term. So we like companies that are in consumer staples and consumer discretionary. We like companies that are in healthcare and life sciences. We like companies that are in internet and technology, that are in digital transformation in one form or another, which is one of the key drivers for global growth. If you look at the portfolio composition, it hasn't changed much. So we, as you know, we have a long-term holding period of 5 to 10, in many cases with a target of 25 years. And a number of stocks that we have, like Amazon or like Alphabet, Google, go back to the formation of the portfolio in 2012. So truly long-term holdings. And if you then look at it from a traditional GIG sector allocation perspective, you can see it's highly diversified, with healthcare and information technology the greatest exposures. If you look at it from a thematic allocation perspective, which is how we think of it, in terms of the underlying drivers of the businesses, you see that the dominant internet and technology franchises in digital transformation are 38% of the portfolio. Pharma, healthcare, and life sciences are 24%. Global leaders with recurring businesses, which is how we think about consumer companies, is 20%. And global leaders with cyclical exposure is 18%. So again, I want to highlight that the portfolio is highly diversified. So the performance that we've been able to achieve has not been because of a singular bet on one particular investment theme, or even a singular bet as such, in our belief, in some kind of conventional investment style, and certainly not in terms of a reliance on a particular sector. But it's rather a combination of companies that fulfill the criteria we're looking for with diversification, and that therefore can perform over time. And if you go back and you ask the question around how they performed, then you would see that we've had different drivers in different times. But the second point that basically comes from that is the point that it's not just about these allocations in terms of the underlying themes that the companies are in. Everything we do is bottom up. So we invest in the actual companies that we invest in. We have close relationships. We do the work to research them. And we've put together here for you an analysis of the digital transformation companies that we've owned over the holding period since we bought them, how they've performed compared to some other markers. And what it shows to you is that we are able to add value, not just by being in the right place in terms of where the overall global growth comes from, but in terms of the individual companies. So if you look at Adobe, then it has more than five-folded compared to, over the period, a doubling in the MSCI information technology, and obviously a much lower return from the MSCI World and the S&P 500. Alphabet is up fourfold. Their American Tower is up 1.6 times, and we'll get into that. Amazon up 13 times over our holding period, and Activision Blizzard, the gaming company that is one of the stay-at-home winners from what just happened in terms of the pandemic. So the point is, it's not just about being in the right place, it's about finding the right companies. We joke that all of them start with A. That's not deliberate either in terms of our stock selection. But the point is, it is about the individual stocks, and so it is about the companies we buy, but also about the ones that we don't. So I think that's the point that I wanted to make about where we are in terms of quality and value, and where we're thinking about how we're thinking about the portfolio. The second point I want to make links back to the quality criteria that we're talking about and ESG. So again, when we say strong and sustainable competitive position, we have always thought about sustainability as companies operating under a type of social license, where as a result of what they do, how they behave towards all of their stakeholders, and how they position themselves and are conducting their business across what they do, they must be operating in a sustainable way. The UN Sustainable Development Goals are a clear framework that has been agreed in order to define what kind of developmental outcomes we're looking for. They've been translated into principles of responsible investment and into other types of criteria like the UK Stewardship Code that have codified and have put them into criteria that apply to the investment management industry. And from a process since we got started of looking at sustainability and of being concerned about it over the last 18 months, we've integrated a process that now has a formal criteria for that. And so we complement the work that we do on the companies from an investment perspective and the investment reports that we write with an ESG analysis and ESG reports for all of the businesses that we invest in. And so it's very clear for us, but we think that it's important to do it ourselves. We of course look at service providers that are out there, but we believe that it is important that we do the work ourselves. Our investment analysts undertake it in parallel to the investment work that they have, because it is as integrated as it is. And we believe we must have a differentiated view on these issues. So in particular, we have a traffic light matrix that we look at when we decide about whether a company has exposure from a financial perspective, which is the point of the ESG ratings, and from the perspective of what it does, which is what is called product impact or other types of criteria. And then we also think about what the risks and what the opportunities are, because the need to be ESG compliant is also not just a risk, it's an opportunity, and it's a growth driver for many of the companies that we invest in. And likewise, we don't have direct exclusion of any particular company. We have a differentiated view, although it's very clear that we invest in some kinds of businesses and not in others. And we engage with the companies in the same way that we engage around investment topics. We engage around, in particular, economic, social, and always governance topics. And we've become signatories to both the PRI and the UK Stewardship with the obligations and responsibilities that come with them. To put this into a clearer perspective, we've laid out some of the results of what we've done. So one, we talked about this traffic light ranking that you see on the bottom left of this chart. We are doing this in terms of the criteria that are applied by SASB. So it is the impact of ESG issues on the financial performance of businesses. That's what's behind the ratings. This is not about product impact. It's about the impact on the financial performance. And for that, we have a traffic light that goes from red to green through different phases. And it also has a gray, which means there is no material impact for the industry, which is a mapping of the SASB criteria on the companies and what they do. And what you can see, and it's not a surprise, but it is good to do in the rigor that we have, that the outcome of it is that most of the companies that we invest in are in the light and the dark green area. So they have virtually no impact from ESG issues on their financial performance. And on the contrary, in many, if not most cases, we think that they are significant opportunities. And likewise, you see there are some that are yellow, and those are the issues that we then engage in. So one of the issues, and to make this more concrete, is the carbon intensity of the portfolio. It goes hand in hand with the idea of quality and sustainability. And what you can see there is that the carbon intensity of the World Stars portfolio is 70% below that of the MSCI World. And that links both things, because from a quality perspective, we're in a world that's about intellectual capital, not physical capital. We're in a world where it's about OPEX, not CAPEX. And we're in a world where it's about cash flows and not book values. But that also means that the companies that we invest in, because they're less capital intensive, because they rely less on fixed costs and less on manufacturing in terms of what they do, they also have a very significantly lower carbon footprint. And we've quantified that here to make the point. And to then look at it in terms of the individual companies that we invest in, we've given you 3 examples here from the impact and the companies from an environmental, social, and governance perspective. On the environmental, and it's connected to the previous analysis of the carbon footprint. From an environmental perspective, the single highest carbon footprint of any business that we invest in is American Tower. That is a global leader in mobile communication. They have mobile towers in particular in the US, but also in developing countries, in particular in India. And the issue is that in order to maintain that mobile communication in India and in other developing countries where there's an unstable grid, they need to have diesel generators that stand next to their towers. So it is an inevitable aspect of what they do that requires them to run this inefficient and ultimately polluting and carbon impacting type of energy supply. But from a perspective of the financial impact, we have it effectively on yellow. If you look at what they do, they're highly engaged in terms of trying to change that and to become more sustainable by investing in renewable energies. In the US, they're already carbon neutral. 23% across the company of their energy comes from renewable resources. In the US, they achieve that carbon neutrality in part by offsetting, which has its issues, but they do it. Whereas in India, which accounts for 81% of the greenhouse gases that they emit, they're working actively in terms of new technologies, both on solar, which we actually think is really the answer to almost any question about renewable energy, but also on batteries and being able to store that energy and to be able to do that at scale and at cost that works for what they do to improve that performance. And so we engage with them. We have ongoing conversations, and we're currently engaged with the company in terms of encouraging them to provide greater transparency and greater communication about the efforts that they're making to allow us to evaluate the steps that they're taking in terms of improving their performance. On the social side, it's a question of Adobe, but it also has to do with, in particular, other of the big digital and technology companies. We feel very strongly that diversity and inclusion is an important aspect of the Sustainable Development Goals and of achieving better outcomes in a developed and in a developing market. Examples that we wanted to give on quality and value and on ESG. And then finally, to get to our perspective on where we are in terms of the pandemic, but also in terms of the outlook for our portfolio. This is a framework that we showed you when we did our last update. And we think that effectively that framework is still describes what the situation is. You've seen from the insights that we've written on particular on the vaccine development and the prospects that we see, that we are really quite constructive about the vaccines, although we have to acknowledge that it will take time for them to be produced in scale and to be distributed and to be effective. Even if we're right and we get approved vaccines, having gone through sensible approval processes by the end of this year. So when we spoke in June, we thought we were at an earlier phase of acute dislocation. We are now at a phase where we're in a different point, where we know much more about the disease, where in particular our healthcare systems have improved dramatically in terms of understanding how to treat it and how to achieve far better outcomes for those who are afflicted by it. But we're also going through a recurrence, which we have had to be worried about, and which we will now see how it impacts, in particular, Europe and the US over the next couple of months. But it does seem so far to go hand in hand with lower hospitalization rates and lower disease rates. And if it turns out that the hospital systems are not overwhelmed, as it seems to be the case, and we're hopeful, then that means that we will be looking at a situation where we do think that within 12 to 18 months, we can get back to something that resembles the types of activities levels that we've had, but taking into account the disruptions to businesses and to the way that we lead our lives, do business and consume that we're seeing. It just so happens that we think that our portfolio, because of our criteria, is quite well positioned in terms of companies that contribute to that and that in that sense are contributing to growth and to recovery and are not among the ones that are as heavily impacted. We clearly are also looking at political disruption. We are looking at the US elections and at Brexit, and I think we can talk about that in the Q&A if you'd like. Our perspectives, we from an investment perspective tend to look through these things and have a ongoing constructive view about the global alignment of incentives for the achievement of growth and prosperity that really ultimately underlies politics. And that is the driver for, I think, actions, because it is one of the key drivers for elections or re-elections, as the case may be. So if you want to look at then the actual, some of the specific drivers that we have, this echoes what we said to you in June, and our view has not changed much in terms of where we see these opportunities. It's the big changes that we've had in terms of the pandemic and the impact it's had on business and companies. It's the shift from offline to online. It's the change in consumer habits to more e-commerce, but also to greater concerns about health and wellness and to greater accountability. One of the stocks that we've added in the portfolio very well is Givaudan, which is the global leader in flavors and fragrances. And one of the reasons why it does as well as it does is because it's able to provide production accountability for the large global food companies and consumer products companies who are its customers. We think there's increased investment in healthcare. That is very clear. We have all of the companies in our portfolio that are contributing to the fight against COVID, whether that's through testing or through production of lab and hospital equipment, or whether that's through actual involvement in vaccine development from which they benefit. So we are very positive about that. They have been impacted in many cases here by the shutdown of hospitals and the shutdown of elective surgeries, but we think that that's something that is going to come back very strongly. And it is one of the key areas that makes us optimistic about the prospects of the portfolio over the next 6, 12, and 18 months. And then finally, increased CapEx and infrastructure investment. You can see it in the US, but you can also see in terms of the investment in infrastructure that is part of what Joe Biden has said in terms of the portfolio and in terms of what he thinks is going to be one of the drivers. So I think that adds to our portfolio perspective as we are. So with that, I'll pause and we can talk about our outlook.
So altogether, you have seen that we are reasonably confident about the outlook going forward. Albeit by recognizing the challenges and risks which are posed by this unprecedented pandemic. Nevertheless, we believe that our position, our portfolio is very well positioned, and whilst some valuations might be ahead of themselves, we believe that despite this, we have significant opportunities ahead.